Hey everyone, welcome back to the channel. Today, we're diving into the world of investing with a beginner-friendly guide to ETFs and mutual funds. Don't worry, these terms might sound intimidating, but I promise to break them down into bite-sized pieces. So, what exactly are ETFs and mutual funds? In simple terms, they're both ways to invest in a basket of assets like stocks or bonds with a single purchase. Think of them as pre-built portfolios managed by professionals. This makes it super easy to diversify your investments, even with a small amount of money. Instead of buying individual stocks from different companies, you can buy shares of an ETF or mutual fund that holds stocks from hundreds or even thousands of companies. This spreads out your risk and potentially increases your chances of earning a return. Stay tuned as we explore the differences between these two popular investment options. Let's start with ETFs, or exchange-traded funds. Imagine a basket filled with different stocks. This basket is the ETF, and each stock inside represents a small piece of the overall fund. When you buy an ETF share, you're buying a tiny piece of that basket. ETFs are traded on stock exchanges, just like individual stocks. This means you can buy and sell them throughout the trading day, and their prices fluctuate in real time. This makes them very liquid, meaning you can easily convert them back into cash whenever you need to. One of the most popular ETFs is the SPY or Spider S&P 500 ETF. This ETF tracks the S&P 500 index, which comprises 500 of the largest publicly traded US companies. By investing in SPY, you're essentially investing in a small piece of each of those companies. Another example is the QQQ or Invesco QQQ Trust, which tracks the NASDAQ 100 index, focusing on large-cap technology companies. ETFs offer several advantages for investors, especially beginners. Let's take a look. First, low costs. ETFs typically have lower expense ratios compared to mutual funds. This means you keep more of your returns. Next, flexibility. Trade ETFs throughout the trading day, just like stocks, giving you more control over your investments. And then, transparency. ETF holdings are readily available, so you always know what you're investing in. For example, the VTI, or Vanguard Total Stock Market ETF, provides broad exposure to the entire US stock market with a super low expense ratio. This makes it a fantastic option for long-term investors seeking a diversified portfolio. Another popular choice is the VNQ, or Vanguard Real Estate ETF, offering exposure to the real estate sector without the hassle of buying physical property. Now, let's move on to mutual funds. Unlike ETFs, mutual funds are not traded on stock exchanges. Instead, you buy and sell shares directly from the mutual fund company. When you invest in a mutual fund, your money is pooled with other investors' money. A professional fund manager then uses this pool of money to buy and sell securities according to the fund's investment objective. Mutual fund prices are calculated only once per day, at the end of the trading day, known as the net asset value, or NAV. This means you don't see real-time price fluctuations like you do with ETFs. One well-known mutual fund is the Fidelity Contra Fund, or FCNTX. This fund focuses on large-cap growth stocks aiming to achieve long-term capital appreciation. So, mutual funds also have their own set of advantages. First, there's diversification. Like ETFs, mutual funds offer instant diversification by investing in a variety of assets, which can really help reduce risk. Then, there's professional management. Your money is managed by experienced professionals who actually make those investment decisions on your behalf, which is pretty reassuring if you don't want to pick every stock yourself. And of course, there's convenience. Investing in mutual funds can be as simple as setting up automatic investments through your brokerage account, making the whole process really straightforward. Now, let's look at a couple of examples. The Vanguard 500 Index Fund, or VFINX, is a popular choice for investors who want to track the S&P 500 index. It's especially known for its low costs and consistent performance. Another example is the PIMCO Total Return Fund, or PTTRX. This one's a bond fund that aims to provide current income and capital appreciation. While both ETFs and mutual funds offer advantages, it's essential to understand their drawbacks. When it comes to ETFs, there are a couple of things to keep in mind. First, buying and selling ETFs typically involve brokerage commissions, which can eat into your returns, especially if you're a frequent trader. Also, not all brokers offer fractional shares for ETFs, so you might need a larger initial investment. Now, let's talk about mutual funds. They generally have higher expense ratios compared to ETFs, and that can definitely impact your overall returns. Plus, you can only buy or sell mutual funds at the end of the trading day, which limits your control over timing your investments. And mutual funds can generate taxable dividends even if you don't sell your shares. Understanding the tax implications of your investments is crucial. So, here's a simplified breakdown for ETFs and mutual funds. ETFs are generally considered more tax efficient than mutual funds. You'll typically only owe taxes when you sell your shares for a profit. On the other hand, mutual funds can generate taxable dividends even if you reinvest them. Plus, selling your shares can also trigger capital gains taxes. It's always best to consult with a qualified tax advisor for personalized advice. Let's do a side-by-side comparison of ETFs and mutual funds. When it comes to trading, ETFs are traded on stock exchanges, while mutual funds are bought and sold through fund companies. For pricing, ETFs offer real-time pricing, but mutual funds are priced just once per day at their net asset value. In terms of liquidity, ETFs are highly liquid, whereas mutual funds are less liquid. Expense ratios are typically lower for ETFs and typically higher for mutual funds. Tax efficiency is generally better with ETFs, while mutual funds can be potentially less tax efficient. And finally, trading costs for ETFs usually involve brokerage commissions, while mutual funds may have transaction fees. Investing in ETFs and mutual funds is easier than you might think. First, choose a brokerage account. Many online platforms offer access to a wide range of ETFs and mutual funds. Next, research and select your investments by determining your investment goals and risk tolerance. Then, place your order by specifying the ticker symbol and the number of shares you want to buy. Remember, investing involves risk, and it's essential to do your own research or consult with a financial advisor before making any investment decisions. That's it for today's video. I hope you found this beginner's guide to ETFs and mutual funds helpful. If you did, please give it a thumbs up. Subscribe to my channel for more investing content and leave a comment below with your questions.